BlackRock are in serious trouble. A couple of weeks ago, they saw a 100% loss on a loan that they had considered perfectly safe and absolutely certain to be paid back in full just 20 days prior. And this has opened the kimono, exposing BlackRock as an extremely delicate house of cards. But now, the situation has gotten worse. BlackRock's very own private credit fund has failed so badly that BlackRock are literally having to give their customers extra money to stop them from running from the doors. And this fund of BlackRock's that's failing, it's a collateralized loan obligation fund, basically the exact same instrument that took down the entire global economy back in 2008. So in this video, I'm going to explain exactly what is happening, why BlackRock is in so much trouble, and what's likely to come next. Now let's start off with the very basic facts so no one can accuse me of being biased at all against BlackRock. This is coming straight from Bloomberg. A portfolio of private credit loans managed by BlackRock has performed so poorly that the money manager has waived some management fees, a rarity in the credit world. The asset manager funded the loans by selling bonds known as collateralized loan obligations, which means the portfolio has to perform well enough to regularly pass a series of tests. Failing to clear those hurdles can spur BlackRock to take steps to right the ship through, for example, automatically diverting interest income away from riskier tranches and towards safer securities. In October, the portfolio value declined enough to breach an over-collateralization, or OC test as you'll usually see it referred to, which means the value of the vehicle's loans was too low compared to the highest rated bonds. The fee deferral, which included cash from the deal's riskiest tranches, helped rectify the October breach, according to a person familiar with the matter who was asked not to be identified, discussing private information. Failing the OC test is unusual for higher rated tranches of CLOs, which have long touted resilience because of their self-correcting nature. Whilst bondholders in the CLO might not actually lose money, the performance of the portfolio raises questions about the outlook for the broader private credit market, which has mushroomed in recent years but is now showing signs of weakness. So BlackRock has a fund that invests into CLOs, or collateralized loan obligations. Basically, you take a normal loan backed against the value of an asset or a car, or in this case, usually a company asset instead. Then you follow this little diagram here, literally posted onto BlackRock's website by themselves. You take, say, 100 of these loans, you stick them into one big package, and you sell that package on to investors stupid enough to never actually look inside the package at what they're actually buying. However, only about 1/3 of the actual loans within that CLO, which is headline listed as AAA rated, would actually be AAA rated. The rest would be far less safe. And that is literally exactly what happened during the global financial crisis, except then they called the packages MBSs, or mortgage-backed securities, and now they've changed the terminology around, but a little bit more on that later. Now, why does BlackRock in particular now involve itself in these insanely risky markets that took down the global economy? Well, again, let's hear it directly from BlackRock. Today, more investors are allocating to CLOs as their floating rate coupons can offer potential protection from interest rate volatility. Protection from volatility, that's the really important thing there. Also, they can get higher yields compared to similarly rated corporate debt. Again, that's because there's a lot of them, so the risk is supposedly lower. Today, CLOs are no longer considered a niche market, having matured to a $1.2 trillion market globally. So it's a $1.2 trillion market at the time this was released by BlackRock, which was about a year ago now. And so CLOs are certainly not a small fish. And one of the key reasons that investors are so interested in them is because they're in the private credit market. They're in the gray market where things aren't really that transparent. So they aren't held up to the same difficult standards as typical public investments, which have a constant stream of buyers and sellers giving a market price. Now that's great for investors because they think that they're getting better returns than they actually are. And BlackRock are going to say that their loans that the investors have bought into, they're solid as a rock and they're sure to pay out big time and make their customers rich. But because the loans are massive and private with no floating market prices, the investors never actually know what the true value of the asset they hold is. They only know what BlackRock say the price is. And obviously, this is great for BlackRock as well, because they can just claim that all is well, that the portfolio has gone up in value, but they don't have to actually pay out their investors yet and put their money where their mouth is. Now, just to show you how ridiculous this can be, I'm going to give you a specific example, and we're actually going to look into one of BlackRock's CLOs. Here you are, it's called iShares BBB to B rated CLO Active ETF. Now, this is one of BlackRock's CLOs. Again, it's BBB rated, that's the headline figure, but actually it has tranches going all the way down to B that simply anyone can invest into just by buying the ETF. It's really, really easy. Now, BlackRock, you see here, claim that the 6-month performance for this fund has been 4.5%, which is really not bad at all for a fixed income asset. But what happens when we actually look inside the CLO? Now, this is the information that BlackRock actually gives us. Each of these is one of these collateralized loan obligations, and scrolling along here, we can see all the different bits of data that they give us. But I want to focus on 3 things here. We have market value, we have notional value, and we have par value. Now, par value is the actual value of the assets, right? These are debts, essentially, something like a commercial mortgage. This one here, you can see, is a commercial mortgage worth about $4 million. But the market value shows it to be worth $4,038,540.92, right? So it's gone up in value by about 1% since this tranche was created. Now, a market value is obviously supposed to be the actual current live price of this asset, but this asset is not currently trading. So there actually is no market price. So where did that market value come from? Well, it came from this tab here, the notional value, which you can see is literally exactly the same down to the penny, $4,038,540.92, just under a 1% gain from the par value or the true value of this fixed income asset. Now, that notional value, that is determined by BlackRock themselves, not some kind of floating free market, which means this market value here is literally a scam. And this is the same with every single security that you see within this CLO. The par value is 4 million, 3 million, and then the market value is a little bit more. This one actually by more than 1%. This one was 2.5 million. This one here was 2.5 million before, and now the value, according to BlackRock, has gone up by $20,000. This one was 2 million and it's up by $15,000. This one was 1 million and it's up by $21,000. But don't make the mistake of thinking that these are true market values. Not a single one of these securities trades on the open market. None of them are free floating. None of them have an actual market value. Now, to clarify here, currently in the United States, bankruptcies are at a record that has not been seen since the global financial crisis. Private credit in particular has seen multiple multi-billion-dollar collapses over the last few months alone. Jobs data is starting to get seriously worrying, with the employment market in the States getting actually quite bad, and the US economy is growing only because of the AI bubble, which is fueling massive speculation and massive fraudulent investment and circular deals into AI data centers. And in the case of this BlackRock B-rated CLO, which is so much worse than it sounds, by the way, B is literally the lowest rating possible, BlackRock are claiming that the underlying value of all of the loans within this collateralized loan obligation have increased in value over the last 6 months. Meaning that the companies that took these loans out and that are going to have to repay these loans, they are more likely to repay than before and less likely to go bankrupt than before, despite the fact that the economy is worse, the job market is worse, and that actually we're seeing a slew of bankruptcies race across the American economy. The point here is that BlackRock get to decide how well these CLOs perform. They get to decide what the supposed market value of the assets inside them are worth, and we just kind of have to take them at their word, right up until a loan stops paying altogether, and BlackRock then have no choice but to admit that the world that they were wrong. And we just have to take them at their word, right up until a loan just stops paying out altogether. And then BlackRock have literally no choice but to admit to the world that they were wrong and that these loans were actually worthless for months and they were just lying to us. But let's get back to the actual news here, that BlackRock's CLO has just failed. So why has it failed? What exactly went wrong for BlackRock to fail this over-collateralization test? Well, the CLO in question is called BlackRock Baker CLO 2021-1. It contains loans of a slew of troubled companies. One of those is Renovo Home Partners that I spoke about on a video literally yesterday. They filed for bankruptcy earlier this month. BlackRock drastically revised to zero the value of private debt it had extended to Renovo after deeming it worth 100 cents on the dollar just some weeks before. So exactly what we just saw within that Excel spreadsheet, one of these companies had actually basically gone bankrupt. They had zero prospects of being able to repay that loan, but BlackRock had not adjusted the notional or the market value of that asset and claimed that it was still worth 100% of its par value of the amount that BlackRock actually gave out. Another loan is to educational software provider Pluralsight, which private credit lenders took ownership of last year. The CLO also holds debt provided to Astra Acquisition Corp, which filed for Chapter 11 bankruptcy in September. It's not the first time that senior bonds in the BlackRock CLO have failed their over-collateralization tests. The higher-rated debts tripled its OC test in October last year and has cured and failed the test a few times since, according to data compiled by Bloomberg. The riskiest bonds of the CLO have continuously failed their OC tests since April 2024, more than a year ago. This forced S&P Global Ratings to downgrade the deal's junior D and E tranches in December, citing the deteriorated credit quality of the underlying portfolio. The CLO, which BlackRock priced at $495 million in late 2021, launched into a red-hot private credit market. Funds flush with cash and competing more intensely to win lending business were relinquishing key safeguards and piling on leverage, riskier behavior that can amplify problems if companies run into trouble. Now, the CLO market was worth about $1.2 trillion at the start of this year. By the end of next month, it will probably be worth somewhere in the region of $1.7 trillion, and it has seen a rush into the market, with investors desperate to get involved in this, taking on more leverage as they do it, taking on more risk as well. And it's seen heavier weightings towards private credit as well. And it's seen heavier weightings towards private credit, which is in the process of collapsing right now as we speak. BlackRock is also grappling with another soured investment. The firm's recently acquired HPS Investment Partners has zeroed out roughly $150 million in debt. CLOs backed by either bank loans or direct lenders are on track for another record year in terms of how much capital they're raising. More than 1,000 CLOs worth more than $470 billion have been priced this year, up from last year's record when they did about $424 billion. While most CLOs are backed by loans that banks give companies, private credit firms have muscled into the space with the loans that they extend to smaller firms also being securitized and sold. Now, BlackRock have created 29 different CLOs over the last couple of years, all of whom have been treated and priced like the one that I just showed you a moment ago. And the CLO that has actually seen this crisis of literally not having enough cash on hand to even be legal was rated as AA, the second highest rating it can possibly get. Despite supposedly being very highly rated, they've had a bunch of their loans marked down to zero as the companies who took them out have gone bankrupt. And most of BlackRock's CLOs are far below the AA rating, most of them in the single A or even down into the B ratings, and yet BlackRock is claiming that they are more safe and that they are more valuable than they were before. Now, this is genuinely ridiculous and 100% should be illegal, and unfortunately, in my opinion, it's incredibly likely that this is going to go in the exact same direction as the global financial crisis, right? This hugely over-leveraged financial system is once again based on these incredibly complicated debt instruments, which are specifically designed to be difficult to understand and to sound that they're better than they are. I mean, calling something BBB rated sounds brilliant, but that's actually really bad. Calling something B- rated sounds like it's at least middle of the pack, but that's literally the worst a CLO can get. And so the vast majority of the people buying into these CLOs, they don't actually know what they're buying. And we are going to see either an outright open bailout like we saw in 2008 when all of these financial institutions collapse again, or maybe we'll see infinite money printing like we saw with the COVID crash, leading to massive inflation that again costs you in the end anyway. Now, I genuinely genuinely don't see any real outcome or realistic outcome where any Western country isn't in dire trouble after all of this. And our governments will literally be incapable of not stealing from ordinary citizens like you and me to pay off this private credit and this financial disaster, which is why personally I'm so cautious with how I protect and grow my assets. And I'm personally focused on just trying to squirrel away as much as I can whilst the sun is shining with my online business. And I think that it's so important that we're able to recognize that and to protect ourselves against what's coming, because it is unfortunately going to be bad. And I want to help you prepare for these problems. So I've put together, and I'm going to be running a free class teaching you how to build a $3,000 a month online side hustle from scratch today. It's 100% free. I've spent the last month putting this class together, spending dozens and dozens of hours on it. And in it, I'll show absolutely anyone how they can use this new system that my team and I have built to build an online income up to $3,000 a month guaranteed. Now, there are limited spaces available for the free class, only 100 actually. And the last time we ran one of these classes, the spaces filled out on the first day we announced it. So click that link down below in the description to save your space and to see what time the free class is actually happening on your time zone. Again, it's free. I'll show you everything you need to know to build an online passive income without needing any prior experience, so you can protect yourself from a crisis like the one that we're currently seeing, and we'll even have some fun on the free class as we do it as well. Now, in the wake of the global financial crisis, banks realized that essentially the gig was up. They got their bailout and they couldn't lever up on mortgage-backed securities or collateralized debt obligations, MBSs or CDOs anymore, but they really didn't want to stop making money. So in the end, they just sort of switched tactics and they just rebranded the exact same things that they were doing as something new. The new brands went from MBSs, mortgage-backed securities, to ABSs, asset-backed securities, and then CDOs, which are collateralized debt obligations, they became the new CLOs, which are collateralized loan obligations. Those are pretty much the exact same thing. There genuinely isn't really a difference except for the naming convention and the marketing behind these instruments. Now, ABSs in particular may sound a little bit familiar as well, because it was in the news a lot over the last month or two when Tricolor Holdings went bankrupt. Now, Tricolor, they were in the business of giving out car loans to people, and then they packaged up hundreds or even thousands of those car loans into ABSs, asset-backed securities, and some even into CLOs, collateralized loan obligations, and then selling them on. Only Tricolor turned out to be running a bit of a scam. They were giving out car loans to illegal immigrants and fake people with no social security numbers, and just to people who would never be able to afford to pay the loans off at all. Amazingly enough, this statistic is utterly insane. 62% of the people who took a loan out from Tricolor, they didn't even have a credit score. Now, Tricolor then took that already very risky practice of giving loans to people without really any chance of ever getting paid back. They took it one step further. They decided to put the same loans out into multiple different asset-backed securities at once to basically sell the same asset 2 or 3 or even 4 times over and make 2 or 3 or 4 times the profit on each loan that they gave out. Now, over the last few months, that all got exposed and Tricolor Holdings went bankrupt and they got exposed for this massive fraud. And then billions of dollars has now had to be written off across loads of different financial institutions, including even JP Morgan Chase, who were stupid enough to buy this stuff. But let's just take a quick look at Tricolor's ABSs and how they were rated. After all, literally 62% of the borrowers who made up these ABSs, they didn't even have a credit score. Well, this right here that we're looking at now was their most recent ABS that they launched in 2025. And this is what S&P Global gave them for their ratings. Tricolor Auto Securitization Trust 2025-2, that's the second one they ran this year. Class A, so the A tranche, the first tranche, $131 million worth of loans, AA rated, the second highest. Class B, 27 million, A rated, C, 14 million, A minus, D, 17 million, triple B, E, 10 million, double B, and then F, 17 million, just B standard. So the ABS is split up into different tranches, basically just groupings of loans that are, supposed to be of similar risk to each other. But let's keep in mind here that 80% of this ABS comes from these first 3 tranches, which are double A or A minus rated, so supposedly very safe. And this rating was done by S&P Global back in June. To summarize this entire thing, this is the statement that S&P gave alongside this rating. The expectation that under a moderate stress scenario, all else being equal, our ratings on the class A, B, D, C, D, E, and F notes respectively are within our credit stability limits. Basically, they said that everything was okay and that this ABS is fine just 3 months before actually Tricolor became a complete and utter basket case and collapsed very, very publicly, filing for bankruptcy. Now, let's not forget here that within this very specific ABS, because actually after this, a different ratings agency came out of the woodwork and they were paid to go and dig actually deeper into this ABS, this particular one, they're the ones that actually found out that within this very specific ABS, 62% of the loans came from people with 0 credit score. That means they were, for the most part, illegal immigrants within the United States who may have just been deported by Trump and just sold their cars on the street or just driven them into Mexico and gone off without ever having to pay it back. 62% of the loans within this ABS was given to people without even a single credit score, and 80% of the loans within this ABS were rated A-, A, or AA. In fact, the only reason that S&P Global didn't give any of these tranches a AAA rating, they said, is because they've grown very rapidly as a company, Tricolor that is, and they're not 100% sure about their business model going forward. That was the only thing stopping them from actually bumping all of these ratings up a grade. Now, the bad news just keeps popping up for the debt instruments and the financial markets here, right? There was Greensill, which was a really early warning sign to all this chaos a couple of years ago. Then there was Zips Car Wash early on in 2025, then First Brands Group and Tricolor and Renovo Home Partners and Western Alliance Bancorp and Zion Bancorp as well. And the trend here is really, really simple. There's a load of bad debt out there that the borrowers can't afford to repay. And when they miss those repayments, the trillions of dollars in assets that are based off those debt obligations, they all collapse in value. And the reason this is all such a shock every time that a bankruptcy is exposed and BlackRock or some other firm are forced to take this huge loss is because they've been hiding the truth from the world for months or even years. The private nature of all of these CLOs and these ABSs and just private credit in general means that there's no actual price action. There's no supply and demand, there's no buyers and sellers, and we just rely on these financial institutions to be honest and to tell us up front when actually maybe this loan might be going bad and it might not get repaid. But why would BlackRock ever be honest, right? From their point of view, they might as well hide the problem away for as long as possible first and hope that it just somehow fixes itself on its own first. Maybe the economy starts booming and their customers are somehow able to pay off their debt. BlackRock will take the hit to their earnings and their market valuations when all of this becomes public anyway, so why rush to get the bad news out? The simple truth is, there are literally trillions and trillions of dollars of bad loans out there right now being hidden off balance sheets, notionally worth trillions of dollars, and creating that amount of wealth within the economy, but in reality, they're nothing more than liabilities and fuel for the fire. Now, if you want some more help or some more resources when it comes to your finances, again, take a look at my free online masterclass down below with the link in the description where I break down, I'll show you how to build an online income without any prior experience. The link to register for it is down below in the description, but there are only 100 limited spaces as it is a live class, so make sure to register as soon as possible to save your space. If you want to tell me how right or wrong I am about all of this or to make a video about something in particular, you can let me know in the comments down below. I always try and read every comment, and if you don't want to miss out on my future videos, make sure to subscribe. But if you really want to help me, grow this channel and improve the content that I'm putting out and make more videos, well, actually, the best way to do that is to share this video to someone else. Click the share button, send this video to a friend, a coworker, or a family, help them learn more about this debt bubble that is growing in the economy and becoming a massive risk, and help my channel grow as well. There's a serious problem with credit markets right now. American bankruptcies have just soared to their highest level since the global financial crisis. REITs are falling apart, shadow banking has now reared its ugly head, and now the cherry on top is that even BlackRock are feeling the pain, being forced to write off millions of dollars of debt as completely